Hello, good afternoon. I will explain to you what is a balance sheet. You wonder what is it? The balance sheet or state of financial status is a financial report that serves as a photograph by reflecting the financial situation of a company to a certain date. Which accounts do you conform to? Assets, what the company owns. Number two, liabilities, debts. Number three, the difference between this that is the equity or stockholders' equity. It's important to remember that this report is usually done at the end of the business year final balance. However, for information purposes, it is important that you perform them with a monthly, quarterly, or semi-annual period for a better follow-up. The next point is importance. The financial state is of great importance to make known to the owners, partners, and shareholders if the operation of the company has been carried out in the correct way, if the resources have been administered efficiently, and if the results of this process are optimal or are deficient. General balance components: the elements that constitute the state of financial situation or balance sheet are divided into three large areas. Number one, the first area is assets, what the company possesses of values and is classified in order of greater to less liquidity. Number one is current assets, direct goods or credits that may be converted into cash within a period of less than 1 year or at the end of the financial year. For example, cashier, bank, etc. And next is fixed assets. A fixed asset is a property owned by the company, whether tangible or intangible, that does not become cash in the short term and which are usually necessary for the operation of the company, so they are not destined for sale. For example, machinery and equipment, transportation, etc. Next, deferred. They are not properly active, but are considered in this section. They represent costs and expenses that have been postponed to be charged in the future period. For example, insurance prepaid, etc. The next is liabilities. Are the debts or obligations that the company owns in this section. It represents what is owned to third parties. They are classified according to the level of enforceability, that is to say the period in which they are to be liquidated, leaving as follows. Circulating is it the debts of the company with a term less than 1 year. For example, banks obligations, accounts payable to suppliers, etc. Long term. In this category, the debt contracted by the company that must be liquidated in a period greater than 1 year and are identified. For example, bank loans, documents payable. Deferred in this classification are the debts whose application corresponds to result of future exercise at the day of the balance. For example, income received in advance early, etc. And the final is equity or capital, represent the resource that the partners or owner have invested in your company. The total amount of assets must be equal to the sum of the total liabilities plus the capital. The next is objective of the general balance sheet. The main purpose for which a general balance is prepared is to know the company financial position in a given period. In making this report, we will also obtain relevant information to make business decisions. And the final point is the structure of the general balance sheet completes with the following parts. These three different parts. Number one is header, is name of company, balance names according period. Number two is body, is assets, liabilities, and capital counting. And number three is foot, name and signatures of who I performs and authorizes, notes and items and figures of the ordered accounts. There are two ways to make a general balance. Thanks for watching the video.